Welcome back to All Things Money. My name is David Blain, and during today's show, we're taking a look at what we foresee for the year 2011. During the last segment, we finished up talking about inflation, and we see inflation somewhere in the 1% range, maybe a little less, maybe a little more. We see the drivers of inflation being food and beverages, as well as fuel and utility costs. Those are the two big drivers of inflation next year. We talked about how what really gets consumers and the markets is unanticipated inflation. So the consensus estimate for inflation is somewhere around 1%. And so it would be unanticipated inflation or deflation that would cause some changes in the economic outlook to that. We talked a little bit about how the expectations of all the market participants, whether it be stocks or bonds or inflation or whatever, will actually help to be a self-fulfilling prophecy. So if you have any comments or questions on our show, we like to give out our phone number, which is 252-633-0107. Also our email, allthingsmoney@dlblain.com. And visit us on the internet at www.dlblain.com. If you have any comments or questions, we'd love to hear from you. So let's continue on, taking a look at our bond outlook. The outlook for 2011 should be another interesting year for fixed income investors. We have this huge tailwind of the past 30 years of falling interest rates. I don't know if you remember back to the 1980s when you could get like 15% on a treasury bond. And so when bond yields fall, the prices go up. Well, we're at such low interest rates now that most people believe that the next move in interest rates is going to be up, and that hurts the bond investors. We think that at this point, if you have any long-dated bonds in the portfolio, you may want to think of trimming those back, moving towards the shorter duration of the curve. The antidote for rising interest rates, other than owning things that go up when interest rates go up, but in the bond market, is moving your duration shorter. What that means is instead of buying, and I saw someone's portfolio the other day that they, an elderly person, they had come in, a broker had sold them some of these Build America bonds that were being pushed by a lot of the brokerage firms last year. And these things mature in like 2035. And so this poor lady just had no idea what she was purchasing. And when you have a bond that matures 25 years from now, every little uptick in interest rates, the price of that bond is just going to plummet. And so when she opens her statements, she's panicking, and she came to me and doesn't understand this. So my advice to you is, especially unless you're going to hold that bond for the next 30 years, at which time you would get paid your principal, assuming the company or government is still in business, and you would have collected your 4, 5, 6% interest all along. So unless you're going to hold it to maturity, we recommend that people shorten the duration. Keep the average maturity of their bonds, more in the 4, 5, 6 year range, or even shorter. If interest rates continue to go up, we'll probably move it a little bit shorter than that to help negate some of the effect of rising interest rates. The TIPS, Treasury Inflation Protected Securities, are also designed to help buffer the portfolio from rising interest rates. Although most of the pricing for that is built in, so it's really the unanticipated interest rate hikes where TIPS are most beneficial. So in the bond market, we continue to see some opportunities in what we call the spread product. Look overseas, some of the overseas entities, countries, you can earn a higher return. If the dollar declines, the value of those bonds denominated in other currencies will rise. So there are some aspects to some strategies that you can use to offset the effect of potentially rising interest rates. Once again, we don't want you to go out and totally trash your bond portfolio. It's just some subtle changes that as you look out over a long period of time, I just don't think the next 3 to 5 years you want to be in really long dated type bonds. We have about 2 or 3 minutes left, and I'd like to wrap up our outlook for 2011. We've still got a fair amount to go through, so we're just going to hit the highlights, and then I want to spend another minute sort of wrapping up everything that we've talked about the past 3 shows. So first of all, we look at the outlook for the dollar and currencies. We expect the dollar to continue, although it's been strong the latter half of the year. We expect it to, as a global currency, continue to decline in importance as the years go by. We expect it in the short term to move higher, but as the global markets look for an alternative to the dollar in pricing of commodities and oil and things like that, we encourage you to be diversified overseas and take advantage of some of the benefits of having instruments denominated in other types of currency. Gold, everybody always asks me about gold. We own a little bit of gold in most of the portfolios simply because it has been a good diversification tool. We think there may be some room left to run in gold. It is certainly reaching bubble proportions. I don't know that we would be, pouring a whole bunch of new money into it if I were you. In the short term, gold is really reacting to short-term real interest rates, and in the long term, we're not negative on gold yet. We need to see, gold, frankly, stop rising against currencies, stop rising against stocks and bonds for that trend to be reversed before we'll become negative on gold. So we have kind of a neutral outlook on gold. Okay, so that's been 3 shows we've done an outlook. Let's just kind of cover briefly in the last minute here. Stock market, we've seen some correction the first part of the year, but we do think we'll resume the bull market towards mid-year, and then watch out for the bear market. I would watch out for a good 8 to 12 month bear market in the middle of the year. We're sticking with small caps and growth, and then as the year progresses, we want to get defensive. On the economy, we see moderate growth, low inflation. Fixed income, we see a modest yield uptrend, and so you want to keep your maturities short on the bond market. Gold, like we said, long-term trend still seems intact. So for All Things Money, I'm David Blain. We hope you've enjoyed our 2011 outlook. If you missed any of the shows, visit us on the web and catch up.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.